Welcome to the Federal Retirement Podcast. My name is David Raetz from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you may register by joining our email list at bfgkc.com. We also provide in-person retirement planning and benefit education to federal employees. To learn more about these seminars or to schedule a seminar at your federal agency, go to our website at bfgkc.com and click on seminars. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website at bfgkc.com or email me at david.raetz@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoy this topic and hope to connect with you soon.
Welcome to Benchmark's webinar. My name is Patty Riley. I assist David Raetz, President of Benchmark Financial Group. Questions are welcome. Feel free to type them in the chat box or unmute and ask. Today our topic is timing your exit, maximize benefits, and minimize gaps. I'll now turn it over to David.
Well, thanks for tuning into this month's call, everyone. Like Patty was saying a second ago, we thought it'd be a good idea to just pinpoint some of the key variables to be aware of in terms of pinpointing a retirement date or a retirement time frame. It seems like this year was a little bit of a curveball because the buyout offers that were offered forced a lot of people to zero in on the end of September as their retirement date. But generally, in most common years, it's usually people are weighing the pros and cons of, do I retire at the end of December, or do I retire midway through the year, or do I retire right after my birthday? So, like we said a second ago, we thought it'd be a good idea to just touch on some of the key variables to be aware of so that you can maximize your retirement benefits and make an informed decision on retirement going forward. All right, so knowing your retirement system and some of the key tweaks and the differences between the two is obviously an important piece of the pie. So CSRS versus FERS, understanding the system and the foundation of effective planning. Alrighty, so originally, I'm sure all of you are well aware of this fact, but CSRS was the original retirement system. If you're hired on before 1984, you got placed in CSRS retirement system. Folks hired on after 1984 got placed into FERS. And I'm sure over the years you've heard that CSRS, or it seems like the general consensus is that CSRS is automatically better, which that isn't necessarily the case. In our opinion, it kind of depends on whether or not you had a CSRS employee that contributed to TSP. Because on the one hand, they do have a higher pension calculation, but because of the fact that they didn't get a TSP match, oftentimes they're heavily reliant on that pension piece of the pie. Whereas with the FERS folks, they put money into Social Security, but because of that TSP match, oftentimes the FERS retirees at a little bit higher balance in thrift, which that being said, it just gives you more flexibility because TSP has a lump sum cash balance tied to it, whereas the CSRS has a higher pension calculation, but if you weren't diligent about saving money in other pots, then you are heavily reliant on that pension payment as the main source of income. So it's not like one is automatically better than the other. It's all relative, dependent on your specific situation. But in terms of a retirement, timing retirement, depending on which system that you're in, CSRS folks have a little bit more flexibility. So usually best time to retire is any time between the first and the third of the month for CSRS folks. Benefits start the following business day. For FERS folks, you want to target the end of the month. Because if you retire, let's say you retire on the 15th of the month, you're going to have 2 weeks of dead time before they start crunching the numbers for your FERS pension. So going out at the end of the month is an important one for FERS employees. Circling back to CSRS and touching on the time frame again, usually, like we said a second ago, usually the first 3 days of the month are key for CSRS retirement date. Effective retirement date is the next day. Effective retirement date is the next day of that month. So your first pension check would be the following. So an example would be, let's say you set your retirement date for January 3rd of 2024. That means your retirement becomes effective on the books the 4th of January, and your first interim pension check would then, in theory, be dated February 1st. Whereas for FERS employees, usually best to retire at the end of the month. FERS employees retirement, just like CSRS, becomes effective the following business day. But FERS pension check is paid on the first day of the month for effective retirement. So that's one to keep in the back of your mind. So FERS example, let's say you set your retirement date for 12/31/2025. Your retirement then becomes effective on the books January 1st, 2026, and your first interim pension check would then in theory be dated February 2026. Most of the time, the variables that cause a delay in OPM crunching the numbers would be chunks of time that you made a deposit for, or the biggest one is if you have a former spouse or multiple former spouses that are entitled to a portion of your pension payment. If that's the case, you just want to invest some time and do the due diligence that you need to so that there isn't an extended delay in them crunching the numbers for your pension. Age as a factor, right? So age and years of service are two of the key variables in terms of zeroing in on a retirement date. Obviously, they have the most impact on retirement eligibility and the amount of money that you're going to get from CSRS or FERS pension. If you're retiring before minimum retirement age, that's an option oftentimes for folks, but it's kind of like an option of last resort. If you go down that road, there's potential for you to face penalties and potential for you to leave retirement benefits on the table. So, but that one just depends on the difference between the age that you're at retirement relative to age 62. So, like a real world example, we had a client that retired with 19 years of service at age 60. And so the reduction is 5% for each year difference that you are between 62. So in this scenario, the guy was 60, so he was looking at facing a 10% pension reduction to retire in that time frame, which wasn't the end of the world because that was kind of like the same reduction that he was going to be seeing if he went with the maximum survivor benefit. But and he was able to hang on to the health insurance, but not being able to get that first supplement was the variable there. So knowing which benefits are going to be payable relative to the time frame that you go with is obviously a very important piece of the pie for planning purposes going forward. And you always want to balance age, years of service, and income goals when you're taking that decision into consideration. I always think this is an important one to marinate on too. Sometimes the best retirement plan isn't necessarily the best life plan, or sometimes the best life plan isn't necessarily the best retirement plan. Sometimes you got to think how close you're getting to burnout status. And then if that's the case, it's just the exercise and sitting down and taking a look at the numbers. And if your net income is in a zone that you're comfortable with, then what's the point of hanging on for an extended period of time if you don't otherwise need to? So that's a unique one or a unique conversation to have with people, because sometimes they're automatically set on retiring at like 68 or 70, for instance, and they just haven't taken the time to do the due diligence and look at the numbers. And then when you sit down and have that conversation, sometimes that'll speed up people's retirement time frame by years. So moving on, this one's just a refresher on minimum retirement age. So if you're a FERS employee, minimum retirement age is an important variable, but it's important. It's important if you've got a lot of years of service under your belt, because the milestone to retire with an unreduced FERS pension would be minimum retirement age with 30 years of service. So you'd be looking at, like, now most of the people hitting MRA are in that age 57 zone. So you'd be age 57 with 30 years of service if you're looking at taking advantage of an unreduced FERS pension at minimum retirement age. The other two major milestones for FERS retirement are age 60 with at least 20 years and age 62 with at least 5 years. If you hit one of those, then your calculation factor is 1% times high 3 times years of service. And then if you wanted to take advantage of the full unreduced, which doesn't sound like a lot, but it's an extra 10% on the pension calculation, you'd retire at age 62 with at least 20 years of service. You're retired at 62 or later with at least 20 years of service. That calculation is 1.1 times high 3 times years of service. Sometimes people are deciding, do I want to go now at 60 or hang on to 62 to get that extra 10%? And more often than not, people people have a tendency to go out at 60 as opposed to hanging on to that extra 10% pension buck. But that one's also kind of the biggest variable that impacts that decision is how close you are to burnout status. So moving on to annual leave. It's important to remember that your annual leave is the chunk that gets paid to you in a lump sum balance. So when you formally retire, the first chunks of money that get paid to you are your final paycheck and your annual leave, and those get paid from your agency. Oftentimes people use that leave payment as kind of the chunk that they use for living expenses, while OPM is crunching the numbers and crunching the numbers for your final first pension payment. It's often used as, like I said, it's often used as a bridge to get you from income gap at the point of retirement to OPM's paying you your full updated first pension amount. Payment usually, like we were talking about a second ago, it's one of the first payments that rolls in. It usually gets deposited 10 to 40 days following your formal retirement date. One of the variables that you remember about the annual leave payment, though, is that Uncle Sam will automatically withhold 20% of the gross amount off the top for federal taxes. And you don't have any option there. That was just kind of a standard operating procedure for those lump sum payments. And most retiring employees will be on interim pension payment for about 2-3 months. Generally, it takes about 2 or 3 months, but the biggest variable that causes the delay would be like if you had military time that you didn't have a receipt for, or if you had a former spouse that's entitled to half your pension, or multiple former spouses. Chunks of time that you had to pay a deposit for generally are ones that cause an extended delay, but divorces are the biggest variable. And you want to try your best to do due diligence on the front end if you're in that boat. Interim annuity checks, those are usually about 40 to 80% of what your final pension amount is going to be. That's the chunk that they pay you while OPM is essentially auditing your service history and then crunching the numbers for that final pension amount. So yeah, and that one's always kind of a crapshoot. You don't know if they're going to pay you 40 or 60 or 70 or 80%. So that's why people like to have that leave chunk as an extra lump sum amount of money to bridge that income gap. Alrighty, so annual leave and retirement date. So, like we said earlier, for most FERS employees, December 31st is a popular retirement date because it gives you the ability to max out that leave payment. So, in theory, most employers are in a boat where they can carry over 240 hours of leave from one year to the next, and then hypothetically, if you saved all the annual leave hours that you got paid in that last year of employment, you could, in theory, cash out with 448 hours of unused annual leave. And then if your retirement date is 12/31, that leave payment oftentimes gets paid in the following tax year. So that would be taxable income. Like if you're going out 12/31/2025 and you're looking at getting that leave payment, it would be taxable income to you in the 2026 tax year, which is a big deal depending on how much leave you're selling back, because those payments can be anywhere from like 15 to 20 to 25,000 bucks oftentimes. And for whatever quirky reason, the leave year typically ends the first couple of days in January. So setting that retirement date 12/31 means that there isn't an extended delay in your pension getting processed, but you're able to hang on to all that use or lose leave. So you go from use or lose throughout the long haul of your career to try and strategically save as much annual leave as possible in that last year of employment if you're trying to max out that leave payment. But if you don't have a huge balance annual leave, it gives you more flexibility in terms of not necessarily zeroing in on the end of the year for retirement. People don't have a huge balance annual leave. Oftentimes there's more people that will retire midway through the year, right after summertime, if they're in that boat. So it just kind of depends on your individual scenario, but it's one of the reasons why people sit down and crunch the numbers and do the due diligence in terms of planning before they get to that point, so they don't hit any unexpected surprises. Moving on to sick leave in retirement. So all retiring CSRS and FERS employees get credit for their unused sick time. That didn't used to be the case, but I think it was in 2014 when they started giving people 50% credit. And then a couple of years after that, they started giving everybody 100% credit. For over the years, they called it the FERS flu, because when people didn't get credit for it, if you'd accumulated a pretty large chunk of sick time throughout your career, people would just be gone for months at a time leading into retirement. So that's why Uncle Sam decided to start giving people credit for their unused sick time. It adds extra months and days to the duration of time that they use for your CSRS or FERS pension calculation. You just kind of bank in the back of your mind that 2,087 hours of sick leave equates to 1 year of service time. And you can't use sick leave in place of a service credit. So you couldn't retire at 60 with 19 years and then an extra 2,087 hours of sick leave to get you to that 20 years. You got to get to that 20th year based off of your own service history, and then sick leave just adds extra time on top of that. I mean, this one's just a snapshot of a sick time chart, and sick time charts are usually pretty easy to track down, but it's good to get an idea. Like we said earlier, 2,087 hours, 1 year, 9 months is about 1,500 hours, 1,565. 6 months is a little over 1,000 hours, 1,044. 3 months is 522 hours. Alrighty, so strategic timing and just kind of a recap. Annuity starts the next day. It's a seamless transition. It minimizes the income gap between your paycheck and your annuity and combined with a lump sum payout for a larger cash flow. It ensures full service credit. Your final paycheck is not prorated, and then maximizes leave accrual. Working through December also allows maximum annual leave accrual. Lump sum annual leave paid out the following tax year, which is a big one, especially if that payment is noticeable in size. You wouldn't want to retire in like at the end of October or November, for instance, if you're looking at selling back a large chunk of annual leave, because then presumably that leave payment would be paid to you sometime prior to the end of the year, which would add additional income plus the bulk of your annual salary for that year too. So just like the difference in a couple weeks time there could mean whether or not you have that leave be taxable income in the following tax year. And then you get a full year of service credit, cost of living increases, more TSP contributions when you pinpoint retiring at the end of December. Alrighty, so how do you start a retirement strategy? Usually when we're working with folks, it's a multi-step process. It often boils down to several meetings. First meeting, it's always what we call the fact-finding meeting, where we send you a list of identifying information to gather. And the more accurate that information is, the more accurate we can be with the numbers that we crunch for you and review. And the second meeting is where we take all that identifying information and put together a written plan for you that just breaks down choices and pros and cons of what to do for each choice associated with survivor benefits on pension. What do you want to do with your federal employee group life insurance? Income that's going to be paid to you from the FERS supplement, income stream or income strategy for what to do with TSP savings. Usually one of the biggest one or one of the most important calculations that we run for people is the net monthly income comparison, which breaks down your net monthly income while you're actively employed relative to net monthly income as a retiree. So you can zero in on any income gaps. And like we said a second ago, to an income strategy for what to do with TSP savings. And then in subsequent meetings, it's often a strategy in refining that strategy, finalizing what decisions you want to go with, zeroing in on what specific income strategy you want to go with for TSP savings, getting accounts funded, getting assets moved around. And it's the planning process doesn't stop at that point. After the formal retirement, it's an ongoing review process from there, because life happens, and sometimes the plan that you set up at the point of retirement needs to be tweaked going forward as a retiree. What items of identifying information do you need for that first meeting? Obviously, any sort of retirement estimates you can get your hands on are helpful. Copy of a recent leave and earnings statement is always an important piece of the pie, because that's the piece of identifying info we need to run that net monthly income comparison. Estimates from Employee Express, the GRV platform, MyPay, any of those are valuable pieces of info for planning purposes. Just a copy of a recent TSP statement so you can get an idea of balance and the funds that you're invested in, the amount you're contributing to TSP. Any other investment state or accounts that you had earmarked for retirement income. Sometimes people have additional pension income streams or like 401k savings from previous employers. Detail on any life insurance policies that you have and long-term care policies. Oftentimes people might have like term coverage, or if you have whole life policies, it's a good idea to take a look at how much cash you have in them or how far you're into the term relative to the total duration of that. So if you're like 19 years into your 20-year term policy, it's good to know that piece of information so that you don't get an unpleasant surprise. Just a recent Social Security statement, a divorce degree if that's applicable. And then sometimes people will get to the point where they want to incorporate spouse's benefits into an overall plan. If that's the case, eventually we'll have you send over identifying information on any benefits that your spouse has. Um, and like we said, incorporate those into a comprehensive overall plan. How about any questions, Patty?
There are no questions, but a quick scheduling note. We're pressing pause on our Zoom webinars for December and January. We'll be back in February with fresh topics to help you prepare for retirement. In the meantime, check out our podcast and YouTube channel. The Federal Retirement Podcast is on Spotify, Apple, and Amazon. Our YouTube channel is Benchmark Financial Group, Kansas City. Don't forget to like, comment, share, and subscribe. David, do you have anything else?
Thanks for tuning in. If you think of any questions that we didn't touch on, you can give me a call, shoot me an email, or you can go to the website and submit your questions via the website. Thanks for tuning in and hope to see you in the near future.